Hey everyone, this is Mayhem Talking Markets. It's Saturday, January 22nd, 2022. We're looking at a chart of the S&P 500 cash index, and I wanted to draw some attention to what's happening right now. Last week was one of the worst weeks we've had since 2020, and I'm talking about this part of 2020. What's noteworthy is the extreme volatility and cascading selling. One day leading to another day, leading to another day. Each morning with a fake reversal followed by a bearish breakdown in the afternoon. Institutions dumping after retail tried to buy the dip. That reflexive dip buying being consistently punished. And what we can see here on this weekly chart is that the last time the S&P broke below its Kijun on a closing weekly basis was back in the COVID correction. So that's a problem, because now we've made a major technical violation of the short-term uptrend, right? All these other times post-COVID, we had found support at the Tenkan. And when we had violated the Tenkan, it wasn't held for long. These were made up pretty quickly. You can see some of these candles, same kind of action until recently. The September-October route, we did test the Kijun, and we were able to rally right back up. What about this time? It cut right through. That's not good. That's telling me that the price action here is very bearish, that we're in a bearish reversal short term, and we're probably destined to test this cloud if we can't catch some kind of bid and reverse very quickly. As we can see with this week-to-week candle, where we saw a reversal and then we saw it come back right back up and even gap up and continue the uptrend. It is still possible this could be a fake breakdown, just like this was a fake breakdown. But there's also some possibility it could look more like what happened during the COVID correction if there's continuation here. So the price action in the week ahead and the actions of the Fed are going to be very pivotal. We're going to look at a daily chart now of the same. And what we can see in the S&P 500 cash index on the daily is that it's a similar kind of pattern, except for what we're looking at on the daily chart is the tests of the cloud. And what we're really wanting to see is the index not stay below the cloud for too long. So we saw in October, November of 2020, there was this test below the cloud. There was a bearish cloud flip, but we were able to manage to rally above and continue running with a couple cloud tests here and there, but nothing significant until the September-October route that tested the cloud and briefly had one candle even close below the cloud and put the index on one day's basis into a downtrend. And we had another subsequent iteration of that with two candles in a row, really three, that were below the cloud. And now we have two. And with more velocity, you can see with every single one of these other instances outside of the October of 2020, there wasn't this kind of velocity pushing below the cloud. So we're really looking for stabilization and a reversal ASAP, or this could get much more precarious. If we go back to the COVID correction, you can see that when we broke below the cloud and became downtrending on a daily basis, it kept feeding into itself. So we're hoping, if we're bullish, to not see a continuation with gaps down, counter trend rallies, gaps down, counter trend rallies, gaps down, because that's the kind of violent volatility that has happened not only during the COVID correction, but to a lesser extent in the December 2018 correction. So that's something to think about. I also want to take a look at the Nasdaq because it's looking much worse. So from a weekly chart, we can kind of get a sense of this here. We've had 2 weeks where the Nasdaq's been below its Tenkan line, and we've had 1 week now, this last week, where it closed meaningfully below the Kijun. So this is telling us that this index is really in poor shape. You know, you've had a couple of tests like this in the past, you know, and we're not quite into the cloud yet. So we can't say that we're at a point where we're threatening a downtrend on a weekly basis, whereas we had in earlier 2020 when we had the COVID correction, we got into a downtrend then, and in 2018 we had a similar kind of situation there. So it's important to look at how these things have played out in the past. This is that 2018 correction. This is the COVID correction. This is where we are now. So you could kind of see there's the potential for that rollover. It doesn't mean it's going to happen, but the probabilities of it's happening has increased because we've crossed below this last respite of short-term trend support on the weekly time frame on a weekly basis with momentum, with high volume liquidation. We were down 7.51% on the week. So that's violence. That's something that's worth paying attention to in the week, and really the rest of the quarter here is how we behave at the index level. Now, we know that the Nasdaq's going to look worse on a daily time frame. It's meaningfully in a downtrend. It has been. You have this continuation. You had one counter trend attempt to get back in the cloud. It closed there on a daily basis, and everything else for the last 4 days straight has just been straight up selling with each close lower than the last. And that's pretty bearish. That's telling me that really there's no, the buyers are being absolutely overwhelmed. Now, the one thing that could be helpful to bulls of the Nasdaq here is we may get a little bit of a bounce if we can see buyers start to come back in around these October lows. But we're already testing them, so it's not really looking so great here. If we can't get stability there, we have a little bit of support perhaps around this like 14,000 clean mark or just above there from some of these highs that we had back in, oh boy, sorry about that. But yeah, from some of those highs that we had back in September, it looks like there may be a little bit of support there as well. So we need to be careful if we're playing this market from the long or short side with anything longer than an intraday time period, because this thing can move violently either way, even intraday. So just looking back at that one more time, here's where we are now. There's the potential for some support here. We've got a little resistance overhead, as we can see. And then we also have this area of potential support going back to that April-June rally in 2021. I mean, we're taking out so many gains so quickly. You can see that the Nasdaq is in pretty precarious shape. You can also see that it's kind of put in a bit of a double top here. So this, if we do break down from this pattern here, you have that ability to have continuation. Like if we're not able to hold this 14,000 line, it becomes quite likely that 13,000 and 13,420 or so are, I'm sorry, 13,285 would come into play. So this is a pretty nasty looking setup. If you think about it from the perspective of just short-term trading it, the path of least resistance is certainly further down. If you think about it from the perspective of investing in it, it's untouchable right now because there's nothing that resembles a reversal. So if you're looking to allocate capital and you're trying to be very strategic, going shopping here when it just keeps dropping day after day after day, it starts every day with a fake reversal higher, and then just rips the face off the bulls in the afternoon and gets liquidated into the close. That's not what you want to see. You really don't want to see anything resembling that if you're trying to go long. In fact, you really want to see the opposite. You want to see selling into the morning and then buying into the close with a strong close on the day. So, if you look at this thing on a, let's just do an hourly basis here, you could see how some of these days are like a counter trend rally that gets just sold into. And it's been a trend here going on most of this year. You could see it in the Nasdaq here, like the first trading day of 2020, you had this, this sort of fake out rally. We drop, we continue to have this kind of pattern on the fourth, fake out rally, drop, fifth, fake out rally, drop, sixth, fake out rally, gap down into the seventh. You have a nice little rally. It lasts just long enough to get a bunch of bulls trapped, so it goes over a couple days till the 12th. And then you just have the same thing, lower highs, lower lows, lower highs, lower lows, and just increase in the velocity of selling. We also had on a hourly basis that bearish cloud twist, so the Ichimoku cloud has been giving us some signals as well that momentum is not on our side on multiple time frames. So it's really important to heed this. I mean, you can go out to a 4-hour time frame and see similar that no matter what time frame you look at, the chart looks pretty bearish. I mean, even go to a 1-minute time frame, it's still bearish. There's nothing here that looks vaguely bullish at all on the Nasdaq. We have to go all the way out to a monthly chart to really look, healthy. And even then, it's not looking so great. But we're above the Kijun on this chart, but we violated the Tenkan on a monthly basis. Now, obviously, we haven't closed for the month of January yet, but just looking at this for the sake of saying, well, if this month closes here, this sure is a really bad candle that could potentially get even worse. So I'm not too happy about the Nasdaq, if you're trying to be a bull, but if you really want to be unhappy as a bull, you look no further than the small caps. And I want to draw some attention to this because this is a big problem, what's happening in the Russell here. So let's look at the Russell the last couple times it's rolled over. So this is the 2018 rollover, right? This is when they did quantitative tightening, and the market finally started to really capitulate in December of 2018. And the Russell had this sort of it tried to rally. It had been consolidating for a little while. It tried to rally, and when it rallied, it faked a lot of folks out, and then it had these violent sell downs, just violent counter trend rally, sell down, counter trend rally, violent sell down. And you could see that throughout 2019, it was pretty much consolidating for most of the year. Then it had this sort of trying to take out previous highs kind of rally. I mean, this was not a rally that took out the previous highs. It just sort of gave it a college try. Look at that, right on the nose. Right on the nose there. See that? And it couldn't get over. There was enough trap supply over here from all the folks that had, gotten long into this, this is going to be the next big run. And of course it went the other way completely. And so when we finally did recover, when we got back to that level, even for just a second, there was distribution. Now, what makes that more interesting to me is that you had this sort of period of consolidation here. You had this run, and then you had this huge fall. And it's quite similar to what we see in the current chart, where we've had this sort of, like here, this long period of consolidation. We had this attempt to run, right? It broke down, and here it is breaking down. So does that necessarily mean we're going to get the rest? I don't know. I don't have any crystal ball to tell you that, but I can tell you that all the warning signs are there that the probability of that happening is higher, because there was a little period of time where we had weekly support. We've cut right through that. We've closed below it. There's not really a whole lot of support until we get, really, I would say, down to about 190. There's not a lot. A lot of this rally is pretty weak from a technical perspective because it was just up and away. So this area where there was a double test on a weekly basis of about 190 level, that seems like the next level of support to look at. This doesn't seem like where we are here that there's really much to attach ourselves to. I mean, I guess you could maybe hope that you get a little tiny bit of support around 195, but it doesn't seem strong to me particularly. So the Russell looks very vulnerable to potentially repeating this kind of outcome. The one thing I would be looking for is it taking out this 190 and taking out the bottom of the cloud. Similar to what we saw here, where it really couldn't hold prior levels of price interaction. That 143 was a kind of important area. You see price interaction going back, and when it was violated, we went much further down. I'm sure we could take this line down a little further. We see more price interaction here at 140, so that's probably the stronger level of support from just a levels perspective to keep an eye on. When the Russell broke down, below that level, when the candle actually gapped down below there, we saw there was a serious continuation. So anyone that had bought, any of these attempts lower, that was confident that perhaps it was a good investment, got washed out in that route. So you have areas that can come back into play later because of how price has sort of reflexive memory. So I think it's important to keep that in mind. Like just like this was a bottom here, it ended up being a little bit of resistance here for this candle and a support for this candle. These are the ways that prices sort of reflexively react to revisiting levels. And I think it's important to look at because, on the daily chart, the Russell is absolutely in a downtrend. There's just no doubt about it. It's broken below the cloud. It has a bearish cloud twist now. It's below the Kijun. It's below the Tenkin. The Tenkin's below the Kijun too. So you've got the baseline. Basically, the baseline is above the conversion line, which is a bearish indicator too. So let's just take a look at bonds here, because I think this is another interesting indicator as to what's going on. We're going to take a weekly look at the 30-year bond. You can see that this has been in a pretty good uptrend for a while, but the question really is how long can this uptrend sustain? Right now, it's still in that channel. You can see that on the screen. But it doesn't look like a particularly bullish pattern. It looks a lot like a bearish pennant. And it looks like it's breaking down from that bearish pennant now. Now, that doesn't necessarily mean that the fate of the 30-year price is written in stone. But what it does tell me is there's not a very strong appetite for the longer dated U.S. sovereign duration. And when you go to the 10-year, it's actually an even worse chart. You can see, not everyone is a fan of these patterns, but you can kind of see there's a shoulder, left shoulder. There's a head. And there is a right shoulder. So that kind of looks like we're getting that continuation here. Because when you go into the levels and kind of look at where the last shoulder was made, you can see that we're breaking below it. So this is a pretty unhealthy looking chart here. There's a little bit of support where it's trying to break into, where there's a fair amount of price interactivity in the past. But the 10-year looks like it's a head and shoulders pattern. If it confirms below here, we could easily see prices get back to some of these levels that imply a much higher yield on the 10-year Treasury bond. So I think it's important that we watch where are we going to hold. Are we going to hold this 127.33, or we're going to be able to hold 125 if we can't hold that 127.33? Or are we going to get all the way down to 122.87? Any of these scenarios are a nightmare for the Nasdaq. They're not good for crypto, gold, silver, any growth stocks. You'd really, if you're bullish of those things, you'd really want to see it try to rally off this level here and stage some kind of recovery to retest these key indicators. You pretty much have to get above the cloud to be out of the woods and invalidate this head and shoulders. It seems to be playing out. It doesn't look particularly promising there. So when you're looking at all this stuff, of course, we can't leave out ARK. This has been kind of the poster child for everything that's been wrong with the sort of 2021 and on route in growth and some parts of tech. And this is a kind of classic parabolic move that happened from 2020 to early 2021. You could see, the trend line got cracked pretty nicely, and when it did, it was kind of game over for ARK. So there was this nice little trend line at the top that happened really right in like the first part of 2021. It was in February. Once that cracked, it never was able to get back to that level. You can see this. This is kind of like the top zone that was initially established so that every rally was sold into, right? And then it just couldn't even get back there the last time, and it sold all the way down. And we're not near anything that really resembles strong support. So if we're talking about ARK getting support, I would say, probably if you're bullish on this thing, and I would advise extreme caution, you're probably looking at the 60s somewhere. This level I'm pulling up, 67.79, doesn't look particularly strong. I would probably pull it down quite a bit more. You know, maybe just a straight up $50 support target's not unreasonable for ARK, but still, you could see a little bit at 57. There's just a weak price structure here. The best that you could hope for in the 60s might be 63, 65. The whole thing is a mess. This whole price structure on ARK is a complete mess. It really looks like a rolling top. It looks like it's ready to kind of give back all of its COVID gains. Worst case, you know, for ARK, if it was going to do that, it could get back to $40. That would be kind of complete round trip. And that's a pretty sad looking chart. I mean, even when you go out to the monthly chart, you know, it just gets worse. Because you can see it had this parabolic run. Last time it had one, it consolidated. This time, instead of consolidating and running higher, it consolidated and broke down. So the primary trend is now, it's in the favor of bears. Downtrend is the path of least resistance for ARKK. So overall, what we're seeing in the market is a lot of vulnerability across the board. I mean, even when you look at some of the leaders that we've had earlier this year, like the XLE, they look healthy, but they don't look promising. Like this is a dangerous price structure with some gaps that need to be filled in, and we already see some pretty decent vulnerability from that kind of a price structure. We already see it closing below the Tenkan. We see the potential for this to get a little bit more choppy as a bearish cloud twist is coming into play. So I would be careful in energy here. It has been a leader, but it does look precarious. It looks like that price run needs some consolidation or even some sell down. Financials are looking much more precarious than energy. They had been leading, but you can see when the bank earnings started to come out not so great, that sector started to lead the market down. And when it couldn't hold the Tenkan, it was game over. And now we're in a downtrend, and we saw a bearish cloud twist as well. That was a good warning sign here, as was this bearish close, to say get out of Dodge. Now, we can see utilities are still looking pretty healthy overall, but they have some bearish signals going on. They have closed below the Tenkan and the Kijun, both of which are acting as resistance, so caution is warranted. I mean, they've been in a more stable looking uptrend. That is to say, there's less gaps that concern me in this uptrend, but I'm not a fan of this structure. It just, to me, looks a little vulnerable. You have also the Kijun crossing above the Tenkan, which is a bearish indicator. So I would say even the safety stuff deserves a little caution. Gold looks pretty good. It's one of the few areas that actually looks touchable here. It's cousin silver. Similar look. You know, we do want to see it pull out of this vulnerability here, though. We do want to see a continuation of this potential double bottom here. I'd like to see it break above the last candle high. So, you know, if we can get above 25.50 in silver on a weekly closing basis on decent volume, that would be pretty encouraging. The gold miners look pretty terrible. They did not have a good Friday, but they did close above the Tenkan but below a bearish cloud twist, so these look much more vulnerable. I mean, look at the difference between the gold miners and then gold itself. It's a different picture completely. So the last thing I want to talk about is crypto. All I've got to say is this is not looking good, guys. If you're in crypto, be careful. This is, you know, you had warning signs going back to November. Something wasn't right. You had that high you hit, you know, and it just didn't last. The price structure started to get really vulnerable, and you saw not only that there were signs of testing key indicators, this leading conversion line, the Tenkan, and they were testing the Kijun as well. But once we broke below the Tenkan on a closing basis, here it started, but it really continued and confirmed here. You know, everything started to get more fragile, and then we broke into the cloud. Couldn't rally above it for too long, and that was really the kiss of death. That was it. You could see that from there, Bitcoin has been in a downtrend. You know, it's been in a downtrend technically since early December. Look at that huge candle with that just crazy wick that eventually got filled later on. That wick, you know, had to be explored. It wasn't just a fake out. You know, it wasn't just a buy the dip fake out. That wick actually ended up being an area of price discovery later on, and that was important to see. So when you see these kinds of these kinds of wick downs, when they create that kind of gap, it's often in Bitcoin that there's going to be follow through. It's almost always the case that there's going to be follow through. You saw the same thing here with this wick, and then we saw a re-exploration of that price action ultimately to break down. So, you know, with the crypto space, I've been saying watch out with QT and tightening liquidity, because all this stuff is really priced off liquidity. Here's Ethereum. This is the same kind of thing. It's really a top that it can't get back to some of these key levels here every time it's tried. It's just making a lower high, lower low. You could see from Ichimoku, you know, it's the same kind of thing in November. It couldn't stay above the Tenkan, then it couldn't stay above the Kijun. It had a counter trend rally attempt. It made a lower high, broke into the cloud, put in one of these crazy wicks, which similarly with Ethereum created the opportunity for those prices to be explored again later. But it also ultimately closed below the cloud, could not get above it. The cloud, you could see, acted as resistance, pushing prices down, selling into it. And from there, we really saw that the Tenkan began to act as a resistance level that it would kiss and, you know, occasionally flirt with, but ultimately fall below meaningfully. And we were talking about Ethereum was at 4,800. It's now at 2,400. So this has fallen 50% in just a couple months. This is not a store of value. This is a barometer for excess liquidity in the financial system, and it's a barometer of euphoria in retail and institutions. But, you know, until crypto really has a lot more use cases and a lot more broad usage, it's going to be very volatile. I mean, you're talking about something that can, you know, double in a couple months and fall 50% in a couple months, and that's normal. So be careful out there in crypto land. Be careful out there in equity land. Be careful, period. This is a market that is a take no prisoners market. A lot of people are getting injured because they're trying to buy the dip, and they're getting ripped into shreds because this is not, there's been no reversal. There's no reversal in crypto. There's no reversal in bonds. There's no reversal in stocks. There's nothing saying that this is over yet. Does that mean that next week it could still be over? Sure. Or it could go on for longer. We don't know. Wait for the reversal. Don't catch a falling knife. Don't try to be smarter than the market. Let the market guide you. Until next time, this is Mayhem signing off.